The smart money concept is one of the most important concepts in trading. In this video, I'll explain the smart money concept, which every trader should understand, whether beginner or expert. If you want to become a profitable trader, understanding this concept is crucial because it reveals where big players and institutions are trading. Once you understand this concept, you can also trade with them and make profits. So, without wasting any time, let's get started. You're likely facing a problem. You see a support zone on the chart, so you draw a support zone there. Now, you think that when the price approaches this support zone, it will bounce from here. So, you place a buy entry here and place a stop loss slightly below. But the exact opposite happens. The price first hits your stop loss and then moves back up. This happens because big players trap you retail traders and exit the market after making their profits. But you might be wondering, how do you know where the big players are buying or selling? I'll explain this to you in the next section. But first, let's understand who this smart money is. Smart money is people with huge capital, like big banks, big institutions, and hedge funds. These people have large amounts of capital, and they move the market, trap you, and make their own profits. But if you want to make money in the market, you need to be smart too. How? You need to enter where the big players are entering. By doing this, you can make regular profits from the market. But to do this, you need to find supply and demand areas. Supply and demand are those areas where heavy buying and heavy selling occurs at a price. Meaning, these are the areas where smart money makes entry and exit. I suspect you might be struggling to understand this. Let's use an example. Look here, the price has gone up with a big green candle. This is a demand zone, so we'll draw a demand zone here. The next time the price returns to the demand zone, there's a high chance the price will go up from here. So, you'll enter here, right? That's how you do it, isn't it? But you shouldn't do that. This is what traps you. So, I'll tell you when to enter later. And similarly, when the price falls, you can draw a supply zone. Look here, the price is falling with a big green candle, so this is a strong supply zone. Now, the next time the price returns to the supply zone, you shouldn't take a direct entry, otherwise, you too could get trapped. You should only enter when the price retests, and your stop loss will be above the supply zone, and you can use a 1 to 3 target. Many beginners might think that support and resistance, and demand and supply, are the same thing. But let me tell you, they are different. Support and resistance are formed when the price has reversed from a given zone 3 or 4 times. Consider this example. Here, the price first rose, then fell, then rose again, then fell again. This means that this level has been retested twice, so we can call it a resistance level. If the price had fallen again and then touched it and moved higher, it would be a support zone. Now let's talk about supply and demand zones. Supply and demand zones are formed when the price has made a strong move from that zone. Look here, the price rose sharply. This means that buyers are active in this area. Therefore, this would be a strong demand zone. And next, when the price moves down sharply, it means sellers are active here, meaning it's a strong supply zone. But both of these things will only work if you understand market structure. There are 2 very important concepts for understanding market structure, so let's understand them as well. You know, when prices rise in the market, they rise in this way. First, they make a low, then a higher high, and then a higher low, and so on. So, the first thing you need to learn about the smart money concept is BOSS, meaning break of structure. And the second thing you need to learn is carbon monohydrate, meaning change of character. I just explained that when prices move upside, they move in a formation of higher highs and higher lows. According to the smart money concept, as soon as the price breaks its high, look here, the price has broken its high. So, this area is what we call a break of structure. Let me make one thing clear. There has been no break of structure here. Price first fell, and at this point, a break of structure occurred. Whenever this break of structure occurs, it's considered very important, and I'll explain its use later. The second concept to understand is change of character. Have you noticed that price has been moving up, making higher highs, and repeatedly breaking the structure? But price doesn't always go up, it also goes down. Let's say here, price made a higher low, then a higher high. But after that, it couldn't go any higher and began to fall. And then, at this point, price made a low. This low would have broken the previous higher low. So, this area would be a change of character, CH. This means that until now, price was following an upward trend. But now the trend has changed, so this is called change of character, and this confirms that the trend has changed here. So far, you've learned about break of structure and change of character on an uptrend. Now, let's understand how this happens on a downtrend. Whenever the price falls, it follows a lower low and a lower high. So, when the price breaks its lower low, it will be a break of structure. You can draw a line along this line, so this area will be a break of structure. Suppose the price rises here and breaks the lower high, then you will draw a line along this line. This area will be our carbon monohydride, or change of character. This indicates that the price was following a downtrend until now. But as soon as the price broke this lower high, the trend changed, meaning the market is now in an uptrend. Have you understood break of structure and change of character yet? This was very important to understand. But I've developed a strategy for how to trade based on this, and after understanding it, you can trade on your own. To trade using the smart money concept strategy, you need to understand 4 steps. The first is market structure, the second is change of character, the third is supply and demand zones, and the last is entry confirmation. Let's understand them one by one. In the first step, you need to understand the market structure and the direction the market is moving. If the price is continuously making higher highs and higher lows, it means the market is currently in an uptrend. Therefore, you should only take a buy entry here. And if the market is making lower highs and lower lows, it means the market is currently in a downtrend. You should only take a sell entry here. Now, in the next step, we need to look for a change of character, where the market begins to reverse. For example, here, the price has been continuously making higher highs and moving up, but then the price broke this higher low and came down. So, this area will be the change of character for us. This means the trend has changed from here. In the next step, you need to find the supply and demand zones. These are the areas where smart money orders are placed. Suppose the market is currently in a bullish trend and suddenly falls, the area where the fall began would be a supply zone. And if the market was bearish and a strong bullish move occurs, this area would be a demand zone. So, when the price returns to this zone, you can make your entry, but you need to get confirmation first. Now, in the last step, you need to get entry confirmation. To get confirmation, you need to look at 2 things: whether the volume on the candle you are trading on is high or not, and whether the next candle is weak or strong. If that candle is weak, you should avoid that trade. Let's look at an example of how to place a trade. Here, the price is moving up, making higher highs and higher lows. So, this is a strong demand zone for us. And the next time the price reaches this demand zone, you can make your entry here. But first, you need 2 confirmations, whether the next candle is strong or not, and if the volume here is also high, then you can make your entry here. Your stop loss will be slightly below this demand zone. You can keep the end target at 1 to 3. Look here, this setup has worked very well. Consider another example. Here, the price is continuously moving up, making higher highs and higher lows. This means there's an uptrend here. But here, the price broke the previous higher low. So, this area is the CHO and CH area. This means that the trend has changed here. Until now, the market was moving on an uptrend, but from here, a downtrend has started. So, here you only need to create a sell position. So, wherever the price has shown a strong move, we will draw the supply and demand zones. Like I did here. Next time, when the price returns to this supply zone, a bearish candle forms here, and the volume is high, you can make your entry, and your stop loss will be above this supply zone, and you can take a 1 to 3 target. Can you see this profit here too? These were just examples. This smart money concept isn't over yet. If you want part 2, please comment. And yes, let me also tell you that no strategy works 100%. Therefore, backtest this strategy first.